Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang, Patel. Welcome to another episode of the Dr. Money Matters podcast. I'm changing things up today, and I'm doing a solo show. So bear with me. It's my first solo show, and I hope you enjoy it. Before we get started, I just wanted to give a shout out to the recent graduates of medical, dental, optometry, pharmacy, veterinary, podiatry, chiropractic, and nursing schools. If I missed any other health professions, congratulations to you as well. It was a long road, but it'll be worth it. I know many recent grads are now starting residency, and after the initial shock and awe wears off, you'll begin the most rewarding part of your training. Remember to take some time for yourself and maintain your health and your relationship. Okay, on with the show. I wanted to talk today about investing with Robo-Advisor. What is a Robo-Advisor? It's a computer algorithm approach to managing your investment. This generally applies to your stock market accounts. A Robo-Advisor is designed to eliminate the need for an individual to make trading decisions about the individual stocks or ETFs in their account. Now, this is not the same as Wall Street computer-based trading, which are designed to make millions of trades in milliseconds. Rather, it's designed to simulate what a financial advisor does in managing your accounts. They optimize your asset allocation, rebalance your portfolio when necessary to achieve optimal diversification, and some are supposed to do tax loss harvesting to reduce the capital gains and possibly some of your income tax burden as well. Now, these are generally not designed to replace the other aspects of a human financial advisor, such as talking about your long-term financial goals, advice related to insurance, tax advice, things like that. So what are the pros and cons of a robo-advisor? Well, one benefit is that they are extremely low cost compared to the average financial advisor. Most financial advisors range from 0.75 to 1.25% of your assets under management. Now, there is a trend of financial advisors reducing costs or going to a fixed cost or a flat fee model. Whether you have $100,000 in management or $2 million in management, it would be the same cost. But those are still the exception rather than the rule. These advisors are still more expensive than robo-advisors, but as I said previously, they may have a more comprehensive set of services. So if you do end up choosing a human financial advisor, make sure you pick a fee-only advisor who holds the CFP, Certified Financial Planner designation, and is a fiduciary. Fiduciaries have to put the client's need ahead of their own. There are other terminology that can be confusing, such as fee-based advisors. So make sure you really investigate what type of fees you're going to be paying and what designation the advisor holds. So getting back to the robo-advisors, some of the pros of the robo-advisor includes the low cost that the majority of these providers charge. They range from free or no cost for the management to up to 0.89%, which is at the highest level of the ones that I'll discuss, which is pretty close to a regular advisor fee. So the majority of the robo-advisors don't trade individual stock. They trade or manage a portfolio of index funds, and mostly they're ETFs, so not mutual funds, but exchange-traded funds, which trade like stocks but are diversified like a mutual fund. In my opinion, you don't need a robo-advisor to achieve diversification. You can generally do this with a mixture of a few ETFs. But the second benefit of the robo-advisors is that they eliminate this work for you. So if you really don't have any interest in managing your accounts, then this is a way to get the benefits at the pretty low cost. I think that at least at some point you should have some working knowledge of what's happening in your accounts, whether you choose to actively manage them or not, just because there's too many stories of people being surprised when they haven't looked at their accounts for 5 to 10 years about what they're in. And generally the stories you hear are negative surprises rather than, oh, I haven't looked and, oh, my account has multiplied by 10 times my original contribution. That would be a great surprise, but that's not very common. Whether you choose a robo-advisor, human advisor, or to do it yourself, just make sure that you do pay some attention. That's the best advice that I can give. So the next benefit of robo-advisors, and probably one that's talked about the most by the robo-advisors, is the tax loss harvest. So what is tax loss harvesting? Tax loss harvesting is where the IRS allows you to reduce your taxable income or your capital gains tax by subtracting the losses that you've incurred from investing from any investment gains, or up to $3,000 from your actual earned income. So let's use an example. Say over the last 5 years, you had invested in a stock that you put $10,000 in, and that stock has appreciated to $15,000. If you sold the stock in a taxable account, you made $5,000, but you owe the IRS 20%, as most physicians will owe, and possibly more if you qualify for the additional Medicare tax on that gain. So your net return is at least $1,000 less than the $5,000 after tax. Now, tax loss harvesting, if you had a similar, if not a similar, but if you had a loss on a different stock that was $5,000. So you invested $10,000 in another stock and it dropped to $5,000 basically, and you sold both of them at the same time, the $5,000 gain from one would cancel out the $5,000 loss from the other, and basically you would owe nothing. Now, that makes sense because you ultimately ended up the same. You gained $5,000 in one and you lost $5,000 in the second. The advantage of tax loss harvesting comes when you have both of those scenarios as again, but this time you didn't sell the stock that gained $5,000. So you just leave that in and you don't owe taxes on that until you actually sell it in a taxable account. But let's say you sold the loss, the company that you lost $5,000. So now you can take up to $3,000 of that against your actual income. So if you made $200,000 in the last year, you would now be able to subtract $3,000 from your taxable income, and it would reduce your income by $3,000. So now you owe tax on $197,000. Now that doesn't sound like a big deal, but generally that's at the higher tax level. So if you are in the 25% tax bracket, you save $750 in taxes. And obviously, if you're in the 40% bracket, as many of the highest income earners are, you save more. So the government does limit you up to take only $3,000 in losses against your income, but you are allowed to take an unlimited amount against any potential capital gains that you've had. So, for example, if you've gained $10,000 in a stock and you had $12,000 in losses, you can take $10,000 against the gain, which subtracts that gain out to zero, and take the remaining $2,000 against your income. But let's say you had $20,000 in losses. You picked a really terrible stock and this company lost you $20,000. You initially invested $30,000 and now it's down to $10,000. You have a couple of options where you sell the stock and you take $20,000 in loss. And again, you can take any of the stocks that you've had or the funds that you've had that you've gained on and subtract the gains from the loss. But you can, and then any additional remaining loss you can take against your income up to $3,000 for a year. But let's say you didn't have any gains. It was a particularly bad year in the stock market and you didn't have any gains. Well, you can take the $20,000 loss. Now remember, the government only allows you to do $3,000 against your income for a given year, but you can take the remaining loss and carry it forward to the next tax year. And again, you can take another $3,000 against next year's income. And if you happen to have any gains from stocks at that point, you can use that to reduce taxes on that. Or you can continue to take the remaining $17,000 and carry it forward each year subtracting $3,000 from your income until that the remaining amount is completely gone. So it's not the ideal scenario. You obviously don't want to take huge losses against your income to reduce income tax, but it is a little bit of a tax break that you have that actually is worth more the higher your income is. So that's what these robo-advisors tend to talk about. They talk about diversification, they talk about low cost, and they talk about tax loss harvest. So these features can help increase your returns, and by combining these things, some of the robo-advisors claim that it can juice or boost your returns by 2 or more % a year, and that should significantly be more than enough to offset their fees, which are almost all under 1% a year, and the majority are at 0.25% or less. Now, you could do these things yourself too and not pay the fees, but that requires you to be a little bit more vigilant about what you're doing. So now, what are some of the cons of robo-advisor? Well, one is the cost. I mean, it's not for the most part. Now, some of them are free, but the majority do have a management fee. It's a low management fee, and it's significantly cheaper than most of the human financial advisors out there, but it's not free. Also, these are relatively new products, new companies, and they haven't been tested over the long run. Now, a lot of these companies, if you go to their websites, they'll talk about back testing their portfolio against the market over the last 50 or so years. And it's always, nice to see that they can do that. But the reality is you don't know what's happening going forward, and you don't know how these companies will perform. Now, the pro to that is that, these are robots. They're not going to be affected by emotion. It's a question of how you're going to be affected by emotion. And sometimes some people need a human hand to at least guide them through a stock market correction. For example, if your portfolio has dropped by 25% over a 2-week period or 30 to 40% in a year, you have to know yourself to determine how you're going to react in that scenario. If you've been through some bear markets and some bull markets, you might know. And if you're just starting out, you probably don't have any idea. Although if you're just starting out, you should be praying for a bear market because you can get assets at a cheaper price. Now, as I said, the robo-advisor itself is going to act the same whether it's a bear market or a bull market in theory, but you have to be able to control your emotions, and that sometimes is where a human advisor can help kind of allay some fears and speak to you and possibly prevent you from making any investment mistakes. On the flip side, that may not actually happen in reality, and you may pressure your advisor to bail out of the funds at the worst possible time, and then you will regret as the market retraces its gains that you've missed out on the gains and get in at the worst possible time. So in my opinion, I don't think robo-advisors are necessarily a positive or a negative in that scenario. It's just that they haven't been tested. The positive that seems to far outweigh the negative is the low cost. So let's talk about some of the individual robo-advisor service. The most famous ones, and I think some of the earliest ones, are Betterment and Wealthfront. There are other companies now out there that have their own niche, including WiseBanyan, and some of the larger brokerages such as Vanguard, Fidelity, Schwab. They all offer their own take on the robo-advisor services, and there's probably a number that I'm not mentioning, but these seem to be some of the most common. So let's just go to the individual company. Let's start with Betterment. Betterment has a fixed 0.25% fee. Now, it is higher if you want access to a human financial planner. It can range up to 0.5% if you want someone who's human CFP to advise you. But those are only available on the accounts that have over $100,000 or more. Now, there are no fees charged for any assets above $2 million, but for the majority of the audience here, I don't think that's going to be an issue. They use low-cost ETFs, including including those from Vanguard and iShares. There are no trading costs, but remember, the management fee that they charge, whether it's 0.25 or 0.5%, doesn't include the cost of the management fees that the ETFs themselves have. So that adds on average about 0.12%. Betterment claims that their robo-advisors can generate an extra 2.66% in annualized return over 20 years on a $100,000 portfolio. And this is based on a combination of passive investing, tax loss harvesting, and better investor behavior. So now, in my opinion, they break those things down into that 2.6% gain into factors for each part of what I just said. And they generate an extra 0.4% on tax loss harvesting. So now that may be a true gain, and that would outweigh the 0.25% for their robo-advisor service, not including any access to human financial advisor. But the other 2.2% can be achieved by anyone who uses passive investing and just does buy and hold invest. Wealthfront also charges 0.25%, and they claim up to a 2.05% increase in returns due to similar factors as Betterment. One of the interesting things that Wealthfront seems to have that's a little bit different than Betterment or some of the other robo-advisors, they have a service called direct indexing, which instead of using broad index ETF, they actually buy a basket of individual stocks, up to 1,000 of them, that simulates either the S&P 500 or a broader market index, such as a total stock market index. And then that gives you much more opportunity to do tax loss harvesting. So if you have an ETF that reflects the total U.S. stock market, well, if the market has gone up, there's really no tax loss harvesting that the advisor or yourself can do. But there's some of the components of the market invariably have gone down. And so what Wealthfront is saying is that we're going to hold the stock market, but we're going to hold actually each individual stock. And so a company, such as Apple may have gone up 20%, but a different company such as Whole Foods may have gone down 10%. Well, if Apple outweighs Whole Foods in the stock market ETF, then the ETF averages those out to the proportion that the company is worth, and so you only get the gain or the loss that the entire market has done. Whereas if you have the individual stocks, you can keep Apple, not realize a gain, but you can sell the Whole Foods, and now you've got a loss that you can actually take against your other investment gains, or as I said before, you can take up to $3,000 against your actual earned income. So this feature just gives you more opportunities to realize losses, and therefore that may actually be a way to significantly reduce your overall tax liability and improve your return. So that's unique to Wealthfront. They also have this service, but that direct indexing applies to accounts in which assets are greater than $100,000. Further, if you have assets over $500,000 with Wealthfront, they have this feature called advanced indexing, which is even a little bit more different. That, if you have a stock market ETF, and like I said, the example of Apple and Whole Foods, well, Apple is a much larger company, so Apple holds a larger share of the percentage of the ETF than a smaller company such as Whole Foods. Well, their advanced indexing feature, they actually change that up, and they may actually weigh Apple and Whole Foods the same. And there's some research in the financial literature that says that this is a way to increase your returns, because generally smaller companies can outperform the growth of larger companies over a longer period of time when you factor in a broad basket of smaller companies. I'm not sure if that's true, and I'm not sure that it's something that you necessarily need to do, but this feature is unique to Wealthfront, and it is something to consider. But again, that only applies to accounts who have $500,000 or more invested with Wealthfront, like Betterment, uses low-cost ETFs, and again, their average fee is around 0.12%. So that, in addition to their 0.25% fee, results in an effective fee of 0.37%. But virtually all of the companies, you can't subtract out the fees for the individual ETFs. That's just a part of investing. So that's not something unique to Wealthfront. Betterment Betterment has it, and some of the other companies that we'll talk about next have it. So Vanguard themselves has a hybrid model called the Vanguard Personal Advisor Service. So they claim it's a combination human and robo-advisor model. You need $50,000 or more invested with the Vanguard to qualify for this, and their fee is 0.3%, so slightly higher than Wealthfront or Betterment, but you do have access to the human at a lower price point than you did at Betterment. And then also, they also charge you the same ETF management fees that the underlying ETFs have. So if you have over $500,000 invested with Vanguard, then you get a dedicated financial advisor. But if you have between 50 and 500, you get a group of people, so it may not be the same person each time, but they'll generally give you this, the same basic advice. They use mostly Vanguard products, but they could use other companies. And unlike Betterment and Wealthfront, if they use outside ETFs or funds, you may incur some trading for that, but those are generally. Vanguard doesn't offer as much automated tax loss harvesting, but in conjunction with their human advisors, they can give you some tax loss harvesting as you need. The next company is WiseBanyan, and they're interesting because basically they don't charge a fee for management of their basic accounts. So there's no trading fees, there's no fixed fee for assets under management, so no 0.25% fee like the other companies that we've talked about. They also use low-cost ETFs. They only are available at this time for individual taxable accounts and IRAs. So if you're married, you can't do a joint account with your spouse, or you can't have your kids' accounts under a trust account or something like that under WiseBanyan. They do not offer tax loss harvesting for basic accounts. They do offer this service, but they charge the 0.25% for that for accounts up to $96,000 in management, and they don't charge any additional fees after the $96,000. So it is available, but they don't offer it as an automatic part of the service. The next company that offers a robo-advisor is Schwab Intelligent Portfolios. Again, like WiseBanyan, they have no management fee. They do have a $5,000 minimum for this service, and they do offer a variety of different portfolios, and they can tailor it to a conservative, moderate, aggressive tilt, and the expense ratio on those ETFs can vary a little bit. One of the things that Schwab does that some of the other ones don't is they have a cash portion of your investment. So basically, the other ones pretty much, if you put in $10,000, they're going to invest all $10,000 in their ETFs. With Schwab, they do leave a certain percentage cash. And the pro and con of this is, well, it's a pro is cash isn't going to lose money, but you can keep cash in other accounts. You don't really need to cash in your investment accounts. The disadvantage is that if you keep cash in your investment account, that cash is generally not going to generate any income, any growth for you, and so that reduces your overall performance. It's known as a cash drag. And Schwab then takes the amount of cash that you have, and they can use it to loan out to other clients, and they make some money off the interest. Now, it may not be a huge percentage that they keep in cash, but it's something to think about is, do you really need cash sitting in your investment account? They don't do tax loss harvesting at the $5,000 level, but they do offer it if your portfolio is greater than $50,000. A company that some of you may be familiar with from your student loan refinancing, SoFi, offers wealth management also, and they have a robo-advisor service. Also charge 0.25%. They give you the first $10,000 for of assets under management for free. And I forgot to mention, I think Betterment does the same as well. And then anything above that, they charge you the 0.25%. If you are an existing SoFi loan consumer, then they don't charge you any management. Now, they don't have any tax loss harvesting at this point. And their account minimum is lower than some of the other ones like Schwab. It's only $500. One of the other interesting companies out there is Personal Capital. They combine the robo-advisor with a human advisor, but their fees are pretty high, 0.89% on assets up to $1 million, which reduces down to 0.49% at much higher levels, but quite honestly, it's the most high cost of these, and I'm not sure that their services are significantly better to justify the high cost. They do have a great free app that lets you track all your investments in whether you have investments in Vanguard, Fidelity. You can actually centralize them, and they'll actually give you a free diversification analysis tool, and just gives you a place to centralize all your investments if you have them in multiple different brokerages. And that's free. The downside is they will call you to solicit your business, but it's not high pressure and you don't have to do it. Personal capital minimum investment amount is $100,000. Probably not the best for the majority of you who are starting out. The last one that I looked at was Fidelity Go, which is Fidelity's answer to Schwab and Vanguard. It's a 0.35% fee. They use ETFs, again, low-cost ETFs. They're generally Fidelity or BlackRock iShares ETF. They don't offer tax loss harvesting, and they require a $5,000 minimum. Now, many of you have your work retirement accounts through Fidelity. This is separate, and you can't transfer funds into it from your work 401. The last option is a do-it-yourself, and for many of you, I think this is a good answer. But if you're just starting out and you're a little bit averse, then some of the other companies may be beneficial. But let's just go over what it would take to do a DIY account. If you have a retirement account only, and that's your only investment, then I would say don't even bother. You don't need to worry about tax loss harvesting in an investment account. In a retirement account. So some of the benefits that these guys offer kind of goes away. Most of you, whether you have retirement accounts through Fidelity, Schwab, whoever, you have access to index funds, and it's just it's just whether you've chosen good low-cost index fund when you initially started your account. So if you haven't, I would suggest at some point you go and look at your investment choices and try to find a total market account, a total international account, a bond fund, something like that. Or there are some of these that have the target date funds, such as a 2030, 2040, 2050, depending on your age. These target date funds may be a very good solution to really minimize any of the work you do. Now, Vanguard's target date funds are very low cost, but I'm not sure that's the same with some of these other companies. So even though they make it simple and they use index funds, they can be a little bit higher. So that's something you want to check. But even if you don't use a target date fund, like I said, a 2 or 3 fund portfolio that includes a broad-based U.S. index fund, a broad international index fund, and a bond fund are really all you need in a retirement. And if you're just starting out, you probably don't even need the bond fund. I'll put a link up on the website to some simple portfolios from Boggleheads that have different portfolios based on different retirement account providers that'll give you low-cost index investment. Now, if you have a taxable account, there are a few simple options. Again, you can use a target date fund, although in a taxable account, I would say using a few more ETFs, whether you use a 3-fund ETF like I talked about, the total international, total US, and a total bond, or you can split it up even further up into 3, 4, 5, 6, up to 10 different ETFs to get different sectors and still a broad investment, but that gives you a little bit more opportunity to do some individual tax loss harvest. Again, my link on the Boggleheads to the Boggleheads portfolios will give you an idea of different ways to do it yourself. So now I personally do the do-it-yourself model, and I'm not sure that that's the best thing over the long run. My guess is it'll probably come out even, but it's costing me some time. So I'm actually looking at myself to start transferring some over to these robo-advisors. And just based on my short research here before this episode, it seems like Wealthfront has a very interesting model and is good for people who have assets in the range of $100,000 or more. And if you're just starting out and you don't have much in a taxable account, then maybe WiseBanyan is the way to go. But I think any of these services, with probably the exception of personal capital, which seems to to be pretty high cost, are probably pretty good. And if they tend to keep you in the stock market and not make foolish decisions, then that probably justifies the slightly increased cost of using a robo-advisor versus doing it yourself. So I hope you learned something. I know it's been interesting for me to look. There's a huge growth in this robo-advisor business, and we'll see how it pans out for the future. But I think that these companies will tend to do well because it just seems like the trend is continuously going towards more and more lower cost investing and more index investing. And these guys are in probably the best position to benefit from that. But I think in reality, most individual investors are going to benefit from this as costs just come down. So again, thanks for listening. If you have any questions, please feel free to email me at comments@drmoneymatters.com. That's all spelled out, Dr. Money Matters. You can follow me on Twitter at Dr. Money Matters, or you can look to join our Facebook group at Dr. Money Matters. And as I've stated before, I'm not a licensed financial advisor, and so please do your own research before taking any investment decisions and making any changes to your investment plan. So thanks for listening to another episode of the Dr. Money Matters podcast. I hope I was able to clarify some points about robo-advisors. And if you made it to the end of this episode, I really appreciate you listening. We return back to the interview format for our next episode.